Is this end of the road for intraday trading? Let's discuss about the hot topic of the day, which is the new peak margin rules. So, what is this new peak margin rule and how this new peak margin rule will affect your intraday trading? Let's see it in detail. The new peak margin regime is live from today and I've received huge number of queries from you guys. So I thought I'll share its details clearly in a video. First, what is this new peak margin rules or regulations? Until now, the brokerage firms could offer any amount of intraday leverage and from now they cannot. Simple. Starting December 1, there is a maximum intraday leverage that can be offered by any broker. Also, this maximum intraday leverage will keep going down from December 21, which is today, to August 31, 2021. And from September 1, 2021, the maximum intraday leverage will be equal to SPAN plus exposure margin for F&O and VAR plus ELM for stocks. I'll explain it in detail with very simple example in a minute. Before that, let's see how this is going to be implemented. So from today to February 2021, there will be penalty if the margin blocked is less than 25% of VAR plus ELM for stocks or SPAN plus exposure for F&O. Don't get confused about these terms. To put it in simple terms, there will be penalty if margin blocked is less than 25% of the required margin. And from March 2021 to May 2021, there will be penalty if margin blocked is less than 50% of the minimum margin required. And from June to August 2021, there will be penalty if margin blocked is less than 75% of the minimum margin required. And from September 2021, there will be penalty if margin blocked is less than 100% of the minimum margin required. So the rules is completely applicable from September 2021. But it doesn't mean it is the end of the leverage. It is end of unregulated leverage. As simple as that. There are brokerage firms who have used additional intraday leverage to attract customers. Their business will be affected to a certain extent. This extreme leverage is always a problem for a trader. If not regulated properly, most of the traders will blow up their accounts very fast. And with the market in current volatile situation, this is very much needed. There's one more good news as well. The penalty from such shortfall cannot be charged to clients, but has to be borne by the brokerage firm. So it will be strictly enforced because we will not be paying the penalty. The brokerage firm should pay these penalties if there is a additional leverage. So now, what is changing? There are four main changes. Number one, there's going to be a restriction on maximum intraday leverages offered by the brokerage firms. This is what we have already discussed. Let's see it in an example. So for equity, the maximum leverage offered will be equal to VAR plus ELM and it cannot be less than 20% of the actual transaction amount. So if you have 10,000 rupees in your account, the maximum leverage that you can use is 5x. So it will be 50,000 rupees. That's a max amount for which you can have a position in equity. Likewise, for futures and options, it should be equal to SPAN plus exposure. So if you take Zerodha as an example, if you are going to trade in futures and options positionally, you won't see any additional changes with respect to margins. But when it comes to intraday positions, you won't get that additional leverage that you are currently getting. That is not possible anymore. So this is the first change. So for equity, you can have max 5x leverage, and for futures and options, whatever the current leverage that you are getting for a positional trade in F&O will continue to remain same. And this is just for the example of Zerodha because they are already following the SPAN plus exposure margin rule. But with other brokers, this will change. And now moving on to the second change. You should always exit the higher risk or margin position first if you hold a portfolio of F&O positions. This is very important change because if you hold multiple F&O positions in the same stock, it means it is hedged position. You will have 2-leg strategy, 3-leg strategy, or might have 4-leg strategy. But going forward, you should always exit the higher risk or margin position first, and then you should close the remaining positions. So this will definitely affect our multi-leg trading strategies, as we should always exit the trade in a specific order. So this is going to be a bit of challenging task, especially if you are a multi-leg trade player. Moving on, the third change is, if you sell your holdings and use the proceeds for intraday trading, avoid buying back the stock which you sold if you don't have a separate fund or additional funds in your trading account. This is very, very important. For example, if you don't have any money in your trading account, don't sell any of your holdings and buy it back on the same day, because this will indicate that you traded without any margin amount. So this might be new to you, this might be difficult to understand. Just think like this: you don't have any funds in your trading account, so it means you cannot take any trades, right? But if you have some stocks in the portfolio already, you can sell those holdings and you will immediately get some margin, and you can use that margin to take some intraday trades. And at the end of the day, you might buy back the shares which you sold in the morning. So this is currently possible, but going forward, you should not do this, and you are not allowed to do this. Because if you sell your stocks and buy it back on the same day from your holdings, this will be considered as an intraday trade. And since you already have zero funds in your trading account, this is not allowed. You should have margin if you are going to do any intraday trades. Okay. And the last change is, only 80% of the credit from your selling holdings will be available for the trades on the same day. The remaining 20% credit will be done on the next day. So why only 80% of amount will be available on the same day? Let's see it in detail. Assume you have 1000 shares of Reliance in your demat account and there is no money in your trading account. You can sell these shares and use the proceeds to buy back some other stock. This is just selling your existing delivery trade. Thus, no margins are required for this selling. And this value of Reliance shares sold can be used to buy shares of some other company. But assume you sell 1000 shares of Reliance at 10 a.m. today and then decide to buy back the same stock at 11 a.m. today. The issue now is that at the end of the day, this becomes an intraday trade. And remember, I have mentioned that there is no money in your trading account. So this will indicate that you have traded without any money in your trading account, which is not allowed. So even though you sold some shares to create that margin and brought back those shares, so this is not allowed from now on, and this will result in a penalty. So these are all the 4 major changes. So starting today, which is December 1, 2020, there's going to be 4 major changes with respect to intraday trading. 1, there is going to be a restriction on maximum intraday leverage offered by brokerage firms. Number 2, you should always exit the higher margin or higher risk position first if you hold a multi-leg F&O position. And number 3, if you sell your holdings and use the proceeds for intraday trading, avoid buying back the same stock sold if you don't have sufficient funds in your trading account for intraday trade. And number 4, 80% of credit from your selling holdings will be available for further trades on the same day, and 100% of that credit will be available only from T+1 day, that is the next day. So now, how will it affect trading? Intraday trading contributes significant liquidity to the markets. With restrictions on intraday leverage, the liquidity is bound to reduce, and hence the potential impact cost, which means the illiquidity cost for everyone might go up. For example, if you want to trade some stocks, it may not be liquid and you may have to give a higher price for that stock. But high leverage is what usually destroys traders, and without such high leverages, the chances of traders surviving in the market will go up significantly. So hopefully, the higher number of traders participating in the market will make up for the drop in liquidity. And you all know that I am not a fan of leveraging. Lower leverages might be negative in the short term for the brokers and intraday traders, but it is a positive for long term, as the probability of traders' success will improve with the lower leverage, as you won't be able to blow up your account so fast. Also, please remember, this is not the end of the road for leverages. Brokerages will always find a way to come up with innovative ideas. An easy option right now is to use pledged shares. If you have a long-term portfolio of stocks, you can pledge them to your broker and use that as a leverage for your intraday trades. This is fairly straightforward. The only problem is you need to do your investing and trading from the same account to get this additional leverage. So if you're trading with multiple brokers, you may not get this additional leverage from all those brokers. And there might be some other new ideas as well. Let's wait and see how it evolves. I hope this video was helpful. Share and subscribe if you find it useful. Thanks for watching. Have a great day.